The most important number in the global economy right now is not the Fed funds rate. It is not the S&P 500. It is not even the inflation rate. It is the price of oil. And right now, that number is telling us something that every investor, every saver, and every person who buys food or fills up their car needs to understand. Brent crude oil is trading above $111 per barrel as of this week. That is up from around $75 per barrel at the start of 2026. In less than 4 months, oil has risen nearly 50%. And the reason it has done so is one of the most significant geopolitical events in decades, a crisis that the International Energy Agency has called the largest supply disruption in the history of the global oil market. In this video, Signal Markets breaks down exactly what is happening, why it matters to every asset you own, and what the signals are telling us about where this goes next. Before we go further, nothing in this video is financial advice. Signal Markets is an educational channel. We analyze publicly available data and research to help you understand how markets work. Always do your own research and speak to a qualified financial advisor before making any investment decisions. Let's start at the source. The Strait of Hormuz is a narrow waterway, just 33 kilometers wide at its narrowest point, between Iran and Oman. It connects the Persian Gulf to the Gulf of Oman, and from there to the rest of the world's oceans. Before February 2026, approximately 20% of all the world's seaborne crude oil passed through the strait every single day, around 20 million barrels per day, plus 20% of the world's liquefied natural gas, plus significant volumes of fertilizer, petrochemicals, and industrial goods. Imagine a single doorway through which 1/5 of the world's energy supply must pass. Now imagine someone locks that door. That is what happened on the 28th of February 2026, when the United States and Israel launched military operations against Iran. In retaliation, Iran declared the Strait of Hormuz closed, began attacking commercial vessels attempting to transit it, and laid sea mines across the waterway. The results were immediate and catastrophic for global energy markets. Within days of the closure, Brent crude surged toward $120 per barrel, a level not seen since the energy crisis of 2022. The International Energy Agency confirmed that global oil supply fell by 8 million barrels per day in March alone. Goldman Sachs estimates that the blockade has reduced global oil production by 14.5 million barrels per day at its peak, removing close to 20% of total global supply from the market simultaneously. To put that in context, the oil embargo of 1973, which triggered the first great oil crisis and caused a global recession, removed approximately 4.4 million barrels per day from the market. The current disruption is more than 3 times larger. The head of the International Energy Agency described the situation as the greatest global energy security challenge in history. Kuwait, Iraq, Saudi Arabia, and the United Arab Emirates collectively cut production by at least 10 million barrels per day by mid-March, not by choice, but because, with the strait blocked, their oil had nowhere to go. Storage filled up. Wells had to be shut in. The Dallas Federal Reserve modeled the economic impact and concluded that a one-quarter closure of the strait removes close to 20% of global oil supplies and is expected to raise WTI oil prices to $98 per barrel, while lowering global real GDP growth by an annualized 2.9 percentage points. We are now into a second quarter of disruption. The economic damage is compounding. Here is the direct transmission mechanism from oil prices to your cost of living. And it is faster and broader than most people realize. When oil prices rise, energy costs rise first. Petrol and diesel, electricity generation, heating. In the United States, petrol prices hit $4.23 per gallon on April 29th, up more than $1 per gallon from the start of 2026. But energy costs then flow through everything else in the economy. Transport costs rise. Every truck, every ship, every plane that moves goods pays more. Those costs get passed to consumers. Food prices rise because food production requires fertilizer, and over 30% of global urea, the primary fertilizer ingredient, is exported from Gulf countries through the Strait of Hormuz. Manufacturing costs rise because industrial processes are energy intensive. Airlines are adding fuel surcharges. Shipping companies like FedEx and Amazon have implemented fuel surcharges on deliveries. The result, U.S. inflation jumped from 2.4% in early 2026 to 3.3% in March, the largest monthly increase since 2022. And it is not done rising. UK inflation is forecast to breach 5% in 2026. European gas benchmarks have nearly doubled. The European Central Bank has postponed planned rate cuts and raised its inflation forecasts. This is the oil price transmission mechanism working exactly as it always has, but at a scale the world has not seen since 1973. Here is what makes this crisis uniquely dangerous for investors and why Jerome Powell looked so uncomfortable in yesterday's press conference. The Federal Reserve has one primary tool for fighting inflation: raising interest rates. Higher rates slow the economy, reduce demand, and bring prices down. But that tool only works when inflation is caused by excess demand, too much money chasing too few goods. This inflation is not caused by excess demand. It is caused by a supply shock, a sudden external removal of a critical commodity from the global market due to a military conflict. You cannot raise interest rates to bring oil prices down. You cannot make the Strait of Hormuz reopen by making mortgages more expensive. What rate hikes do in this environment is compound the damage. Higher rates slow an economy that is already being squeezed by energy costs. The result is the word every economist fears most: stagflation. Stagnant growth combined with high inflation. The worst of both worlds. The Dallas Fed already projects global real GDP growth falling by 2.9 percentage points in Q2 2026. The U.S. economy grew by just 0.5% in Q4 2025. Europe is facing recession warnings. This is the environment in which the Fed is choosing to hold rates, not because they want to, but because they have no good options. For equities, the impact is negative across most sectors. Energy costs squeeze corporate margins. Transport, manufacturing, retail, and airlines are all facing higher operating costs. Consumer discretionary spending falls as households spend more on fuel and food. The S&P 500 has struggled to hold its recent highs precisely because earnings expectations are being revised down as energy costs rise. The one sector that benefits directly? Energy companies. Oil majors like ExxonMobil, Chevron, Shell, and BP are generating record cash flows at $100+ oil. If you hold energy sector ETFs, this environment is working in your favor. For gold, this is the environment gold was designed for: geopolitical crisis, currency uncertainty, inflation above target, and a central bank that cannot respond effectively. Gold has been one of the strongest performing assets of 2026 for exactly these reasons. For crypto, Bitcoin's behavior in this crisis has been revealing. Rather than acting as a safe haven or digital gold, Bitcoin has tracked the S&P 500 closely, falling when equities fall, rising when risk appetite returns. Its correlation with the S&P 500 has hit a 2-year high. In a genuine macro crisis, crypto is behaving like a risk asset, not a hedge. That is an important signal for how you position it in a portfolio. For bonds, the 10-year Treasury yield hit 4.41% after yesterday's Fed decision. Higher yields mean lower bond prices. In a stagflation environment, bonds typically underperform because inflation erodes the real value of fixed income payments while the economy slows. For commodities broadly, beyond oil itself, the crisis is affecting agricultural commodities through the fertilizer disruption, industrial metals through the economic slowdown signal, and natural gas through the LNG disruption from the Gulf. This is a broad commodity shock, not just an oil story. There is one scenario that reverses this entire macro picture quickly, and markets are pricing in some probability of it every day. A resolution of the Strait of Hormuz crisis. Iran has proposed reopening the strait in exchange for deferring nuclear negotiations. As of this week, those talks have not succeeded. Brent crude rose 3% on Tuesday, even as Iran's proposal was on the table, because markets don't believe a resolution is imminent. But if a genuine ceasefire and reopening occurs, the effects would be rapid and dramatic. Oil prices would fall sharply, potentially back toward $80 per barrel within weeks as supply returns to the market. Inflation expectations would drop. The Fed and ECB would gain room to cut rates. Risk assets, stocks, and crypto would rally hard. Gold would likely give back some gains as the safe haven premium deflates. Watch the Islamabad talks. Watch U.S.-Iran diplomatic channels. Watch Iranian foreign minister statements. Any credible signal of strait reopening will move markets before any official announcement. At Signal Markets, we always end with the signal, the one indicator that tells you what happens next. For this crisis, the signal is simple: the Strait of Hormuz shipping traffic. You can track live vessel movements through the strait at marinetraffic.com. It is free and publicly available. When tanker traffic through the strait starts meaningfully recovering, that is the leading indicator that the energy crisis is easing. Oil prices will follow. And from oil prices, inflation follows. And from inflation, central bank policy follows. And from central bank policy, every asset class follows. One waterway, 33 kilometers wide. And it is currently determining the direction of the global economy. That is the signal. Everything else is noise. To summarize what we covered today, the Strait of Hormuz crisis is the largest oil supply disruption in history, removing up to 20% of global oil supply from the market. Oil prices above $111 per barrel are driving inflation across every economy, directly through energy costs and indirectly through food, transport, and manufacturing. The Federal Reserve cannot fix supply shock inflation with interest rate tools, creating a stagflation risk that is the worst possible macro environment. Gold and energy equities are the asset classes most clearly benefiting. Stocks broadly, crypto, and bonds face headwinds. The one wild card, strait reopening. Watch marinetraffic.com and Diplomatic News for the leading signal. If this kind of macro analysis, connecting a crisis in the Middle East to your stocks, your savings, and your portfolio is useful to you, subscribe to Signal Markets. This is what we do every week. No hype, no noise, just the signal. Link to our recommended investment platform is in the description below. As always, it's do your own research, and nothing in this video is financial advice. This is Signal Markets. Find the signal, ignore the noise. See you next week.